Hey everyone, welcome back to Corporate Dakota. Today, BOXL just filed a 1-for-6 reverse stock split, and I am seeing a desperate move to stay listed. Quick note, this is not financial advice, just my take on public filings for educational purposes. This reverse stock split is happening really fast, and it tells us a lot about the pressure Boxlight is under. So what exactly is happening here? Boxlight Corporation, the company we know that makes technology for education and business, has just executed a 1-for-6 reverse stock split. What this means is for every 6 shares of stock a shareholder owned before, they now own just 1 share. Now, why would a company do this? The filing tells us the main reason is to get their stock price up. Specifically, they want to push the closing bid price above $1. This is a critical number because they need to stay listed on the Nasdaq stock market. Nasdaq has a rule that requires stocks to maintain a minimum bid price, usually $1 to remain listed. If a stock falls below that for too long, it risks being delisted, and that is a really bad outcome for any public company. This move is essentially a survival tactic to avoid being kicked off the Nasdaq. Companies often do this when their stock price has fallen significantly. They hope that by reducing the number of shares outstanding, the price pair will increase, thereby meeting the listing requirement. Now, it is important to understand that a reverse stock split doesn't magically make the company more valuable. It just changes the number of shares on paper. If you own 600 shares worth $0.5 each, your total value was $300. After a 1-for-6 reverse split, you would own 100 shares, and to maintain that $300 value, each share would now need to be worth $3. The company's overall market capitalization, or the total value of all its shares, technically stays the same right after the split. However, the implications for investors can be significant, especially if the underlying business problems that caused the low stock price aren't fixed. One interesting detail here is how they are handling fractional shares. The document states that no fractional shares will be issued. Instead, if a shareholder would have been entitled to a fraction of a share, they will receive 1 whole share. This is a way to round up and ensure that no one is left with an awkward fractional amount, and it avoids the company having to pay out cash for those small fractions. Boxlight has been struggling. Looking at the recent news, we see headlines about their earnings with revenue rising but gross profit falling, which is not a healthy sign. They also had a major stock price drop prediction in late 2025. We also see that their chief financial officer has been selling off stock, which doesn't inspire much confidence, and the market cap is really small, sitting at just $2 million with a current price of $3.58. But this is after the reverse split. Before the split, the price would have been much lower, likely below $1, which is why they needed this action. Historically, companies that resort to reverse stock splits often do so out of desperation to avoid delisting. While it can provide a temporary fix to meet listing requirements, it doesn't solve the underlying business issues. We've seen this play out with many micro-cap companies, about half of micro. Cap companies that do reverse splits often end up delisted eventually anyway, within a few years, unless they can fundamentally turn their business around. For example, Kodak did a 1-for-20 reverse split back in 2021, and their stock continued to face significant headwinds, eventually leading to further operational challenges. Before this split, Boxlight was authorized to issue over 4 million shares of Class A common stock. After the reverse split, that number shrinks dramatically to just over 694,000 authorized shares. This significantly reduces the number of shares that can be in circulation, which is the whole point of a reverse split. The number of authorized shares for their Class B stock and preferred stock remain unchanged, meaning this action is strictly focused on their common stock. The filing also mentions that this reverse split will affect option grants, warrants, and convertible preferred stock. These will all be adjusted proportionally. For example, warrants that used to be exercisable for 1 share will now be exercisable for 1/6 of a share. This adjustment ensures that the economic rights of holders of these instruments are maintained on a per-share basis relative to the new share structure. This filing also includes a press release from the 17th of June announcing this reverse split. It is crucial to note how they clarify that this information, especially the press release, is furnished and not officially filed in a way that would make the company liable under certain securities laws. This is standard language to avoid unintended consequences for the provided information. They are essentially saying, this is for your information, but we are not taking full legal responsibility for it as if it were a core filing. Looking at the exhibits, we see the certificate of change that officially made this reverse split happen, filed on the 17th of June. Trees also that press release from the 17th of June, which likely contained the initial announcement to the public, and of course the interactive data file, which is standard for these filings. Finally, the report is signed by Ryan Zeke, the Chief Financial Officer, on the 22nd of June 2026. This date is significant because it is the date the reverse split officially took effect and began trading on a split, adjusted basis. So, what is my take on this? Boxlight is in a tough spot. This reverse stock split is a necessary move to stay on Nasdaq, but it is a clear signal that the company's stock price has been in a deep funk. The core business issues that led to this low stock price haven't been resolved by simply changing the share count. The risk I am watching is whether this is just a temporary band, or if Boxlight can actually improve its financial performance and regain investor confidence. What I am actually looking for is a path to sustainable profitability, not just a compliance maneuver. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out our Discord in the description for more.